The dollar index, middle of next year, where will it be? S&P 500, where will we be? We're at 6,000 now. And give us a sense on the 10-year U.S. Treasury yield as well.
My view is firmly that I personally think this dollar strength is short-term. My base case on Donald Trump is the dollar strength is short-term, but I think it can run into the inauguration. On the stock market, I think a key issue, which I'm not really the expert on, but it is this issue of there's this bottom-up issue of the hyperscalers, and if the market starts to protest at the amount of money they're spending on AI capex. I think the AI capex investment boom continues next year, which is why I still have NVIDIA in my global equity portfolio. But where I've got greatest conviction is that the Treasury bond market will be selling off. And that the only way that, in my view, is not going to happen if Elon Musk is really allowed to do this dramatic surgery on the federal government. And if he does, then the stock market in the US becomes very vulnerable. In a world where the $2 trillion of spending is cut from the federal government, we're going to get a deflationary shock in the US, and that will definitely cause people to invest in equities elsewhere. But as I say, that is not my
Now let's come to India.
That is not my bid.
Absolutely. Absolutely. Here in India, foreigners have been continuous sellers, one of the biggest sell-offs that we've seen. I mean, in the last couple of months or so. Are we near the end of it, Chris? What's the sense you get?
Yeah, personally, I think we're having a healthy correction in India, which has been led by the small caps, which I think is healthy. We've had, based on the latest data I've seen, we still have these huge domestic flows coming into the Indian market. And what's happened is we've had rising supply of equities because companies have been taking advantage of the high valuations to raise capital. And so we're having a natural correction caused by the indigestion of the supply. But I think it's all really quite healthy. The good news about the foreigners selling is the foreigners have the ability to buy on any sharper correction. But the really interesting point about Indian equity market this year has been these ongoing domestic inflows.
No, absolutely. It's been quite remarkable. Although at the margin, Chris, some are starting to say that maybe demand also is coming off after 3-4 years, even at the premium end. Consumption is starting to slow down. And it doesn't look like, looking at consumer price inflation numbers in India, that a rate cut is around the corner. I mean, at least not till February of 2025. So, are we at that point where we... Sorry, go on.
Sorry? No, I don't think the RBI is in any hurry to cut rates.
Go on, Chris.
But we have had a bit of a cyclical slowdown. Last quarter, we had earnings downgrades. So we do see a bit of a cyclical slowdown in India, but I don't believe it's anything dramatic. I think it's all quite healthy. The RBI had some preemptive tightening this year in terms of monitoring banks' loan deposit ratios. So I just think there's been some healthy preemptive action by the Reserve Bank of India in the recent past, which hopefully prolongs the credit cycle.
Absolutely. Got that. So India still in your global portfolio.
The emerging markets. I think the Indian story is on sort of automatic. Where there's been dramatic change, a pretty dramatic change in the last 2 months in emerging market context is in China. That's where people have been focused, emerging market investors in the last 3 months, because of this change of policy in Beijing. We had a big rally triggered by the change of policy late September with the Chinese stocks have corrected a bit, but my base case is that the Chinese market has put in a bottom, and it seems like the Chinese government is focused on stabilizing the property market and supporting the stock market. So they're basically targeting asset prices. So it seems like the property market in China is bottom for now.
Got it. So within your portfolio, where does India stand? Is it one of the favorite markets? It had been for a long time.
No, my green fair long only portfolio, Asia ex Japan, 25 stocks. I'm still, massively in India, and that's a structural view. And I'm outperforming a lot on that portfolio, so I can afford to underperform for a while if India corrects. But on my relative return portfolio against the index, where I'm more concerned about not underperforming the index in this quarter or last quarter, I've been running India just marginally overweight, and I've been running in China marginally underweight to neutral. So basically, I'm more or less neutral in both India and China. Because if my career depended on not underperforming the index in the short term, it's very risky. It's been very risky in recent months to be very underweight China because it was first very cheap, and you've now had clear signal of this policy change. But the China easing we've seen, it's important to stress, this is not the big bazooka stimulus some people have been hoping for. So I'm running.
Okay, and you don't think once?
Sorry.
And you don't think if the US were to impose tariffs, China will actually come back with a big bazooka?
No. The Chinese. But what I would be investing in with new money in China isn't the exports, as they've clearly got the tariff risk. It's the consumption plays, because the consumption's been very weak. So there's potential for the consumption to improve from a very low base if I'm right that the property market is stabilizing. If I'm wrong and the property market is not stabilizing, China will remain in a then I'm just plain wrong. But in the months of October and so far this month, there's been a significant pickup in residential property activity. And basically, we're running at half the level of peak transactions in China. So it seems to me that we may be running at a level of natural upgrading demand. And we've had significant declines in prices in China, the major cities, up to 40% or more decline in prices from the peak. So we've had a major price adjustment in China.
Absolutely. So just to summarize for our viewers here in India, Chris, it's a cyclical slowdown, a little bit of a pullback. The broad uptrend in India and Indian equities should last for many years. Is that the message you'd want to leave us with?
Yeah, so my view is investing in India via the installment schemes on a monthly basis remains a very sensible way to continue. Which I think is how a lot of people are investing in the Indian mutual funds on these installment schemes. And that seems to me a very sensible way to proceed. And I would continue to do that. And I should also add in the long run,
Chris,
I'm increasingly, just one more point, I'm increasingly constructive on the Indian currency. In my view, the rupee will be depreciating much less going forward than has been the case historically. Historically, one tended to assume annual 6% depreciation in the rupee against the dollar. In my view, that will no longer be the case going forward.
Just to finish that point, at the margin, any particular reason?
Well, I just think the basic Indian macro story is improved. You could see it come in a few years where India is running current account surpluses. And I think that vulnerability to imported oil is gradually reducing. I just think that the Indian story is the quality of the Indian story is improving. Plus, long run, I remain, unless Elon Musk is allowed to do this surgery on the federal government, the long-term outlook for the dollar is bearish because of this dramatic fiscal deterioration we've been seeing in recent years. And one reason why the US economies remain so resilient is incredibly strong federal government spending. 60% of the jobs generated in the US in the last 12 months on the payroll data were from government-related sectors. So this government spending has been driving the economy in the short term, but it's creating this huge fiscal deterioration. And I think one clear reason the Federal Reserve is now cutting rates, but one reason it can't acknowledge in public, is because it needs to get the cost of debt servicing down. And more of the US government is funded by short-term treasury bills. So the duration of government debt has shortened dramatically. And basically Fed cutting rates reduces the interest cost. That's one reason they're cutting rates, but obviously they can't admit that in public.
Chris, it's always such a pleasure sort of listening to you and learning from you. Thank you very much for taking out the time. And I know you had to make a bit of a extra effort for this one. We really appreciate it. Thank you very much, Chris.
Thank you, Prashant. Have a good birthday. And send me that old green fear you mentioned.
I will. 1999. I will send it across to you. Thank you again, Chris. Thank you.
Okay, thank you.